I've invested in more than 70 startups. I'm part of 10 funds as a limited partner. I run my own fund. I keep evaluating startups all the time.
What do you think are the real reasons when investors say no to these founders?
When counter views come from the team, we are worried, is there chemistry among them? Sometimes we find that the founder are not financially disciplined. When we ask for the numbers, they are not able to tell us clearly. Or sometimes, their valuation is completely misaligned. So when we have those fear, what is the obvious answer? We'll either get back or it's too early. So sometimes we may even not be so comfortable saying no because we value the time and effort of a founder. Founders should take it as a feedback. They should probe it politely. They should extract the real reason from the investor over a period of time, if not immediately, and then come back. I never believe in the vision. I believe in vision plus conviction. If that the founders have, I think those founders are the best founders. Let's say the founder is asking for $1 million. The question from the VC is, if I give you $2 million, what is it that will happen to the business? Money can be asked at any point of time. The only question is, are you ready as a founder?
Hi, welcome to another episode of Pivot Point with Usha, where we call founders and investors to answer all the questions that you write to me, that you always keep asking. Our today's guest is an investor who has done more than 70 investments and has a SEBI-registered VC fund. Not just that, he has been a CA, turned into an investor with 20 years of experience, into finance director, into multiple MNCs like ExxonMobil, KPMG, Yardley of London, which is Lonamed Group. So please welcome Chandrashekar Kupperi. So really excited and welcome to the show.
Thank you, Usha. Grateful to you, grateful to Pivot Point for having me. Thank you so much.
Awesome. So let's get started. We would love to understand how your journey started into the investment world, into helping all the companies enter into merger and acquisitions.
So let me get back to the investment world. Usha, 7 years back, I became an angel investor. And I always make the statement that once you start investing, you feel like investing more. So I always say angel investment is quite addictive in the right sense. I'm not saying in the wrong sense, in the right sense.
Yeah.
So started my journey in the last, 4 years. Probably I've invested in many more startups. And I think the intent of investing in startups is, we all know that startups are disruptive. Though we love to work for large corporates, we also say that no, because the corporates are large, we also say elephants don't dance because there's a lot of bureaucracy out there. But startups are very agile and nimble, and therefore it's always exciting. The second thing is that, look at this word angel itself. The whole idea of angel, is to support the journey of a founder. I'm not saying without evaluation, I'm saying you have to evaluate, but then the whole idea of the meaning of the word angel, is to support, someone's journey. And therefore, I think it becomes even fascinating to find out, the idea. And if the idea is exciting, why not even, support that particular founder. And I think the third thing, which I've always personally believed in terms of investing in startup, is that I think probably this is the only chance that we will get to invest early. Because once the startup has become, quite larger, I think the ticket size, probably, their ability to even attract angel investors like us, becomes, like only secondary. It's not primary because they are more looking at venture capital firms or private equity guys. So I think we should be opportunist in terms of, catching them young. That is what is a significant motivation, I had, to become angel investor 7 years back. But then the reason also to become an angel is to also ensure that the experience that we carry, from the various, corporate background, you said ExxonMobil, KPMG, Yardley of London. I think all this corporate background helps you to support the founders with certain structure. For example, how they should look at the market, and therefore, how we can even validate what they've written in the pitch deck. How should they look in terms of, their financial numbers itself? Because we guys come with an expertise on numbers. So how do you look at numbers? How do you show the traction? How do you even evaluate the terms of the agreement, or let's say as basic as term sheet? I think these are some of the areas, where we could add a lot of value. And that also motivated me to start my own, fund, which is called Peaceful Progress. So it's now 4 years old. We have done 24 investments, probably, looking to close, a few more, by March, year end itself. So this has been the sort of, journey that I've had. But let me also share this with you, Usha. I think, experience is the mother of, all virtues. So one thing I realized is that successful investing is never always about money. It's never about capital. I think over a period of time, I've realized that successful investing is all about having the right connections, understanding the market trends, but more importantly, you have to identify passionate as well as capable founders. That sort of curation has to happen over the investor so that they become successful. And that is what is happening with me. Now I invest with a lot of sense of excitement and purpose. I'm actually looking for connecting with founders, connecting with the next groundbreaking idea. That's what has been the journey.
That sounds amazing. And so when you said capable founders, like what are these traits that you look for if someone is capable or not?
There are only three which I look at, Usha. One is, I think they need to have this ability to take risk. What I mean by risk is calculated risk. See, Warren Buffett used to say so beautifully, risk comes from not knowing what you're doing. If we don't know what we're doing, obviously it's risky. So what we do, we take a calculated risk. I think the founder should have that ability, to sort of look at, this venture as an adventure. So they should not take it, as a burden. Anything that they start, they should get super excited about saying that I'm doing something which is above the crowd, and therefore there are going to be issues, difficulties, but I'm going to show that I have that risk-taking ability. That's one. Second is, I always love founders, who look at the problem much deeper. I always say, love the problem, not the solution. So if the founders are able to sort of, go deeper into the problem, understand, that problem is really a pain, then I think they'll be able to come with a painkiller as a solution. Which means, can they live the problem, understand the problem, wanting to solve the problem? If that is a sort of deeper intent, then I think, I truly, love, such founders. The third for me is that I love founders, who are balanced, which means they are okay to show their vulnerability also. We are not looking at somebody, who is like a hero or a shiro. We're looking at normal human being who is doing his or her best to ensure that they can definitely be above the market in terms of competition, or let's say the sort of idea that they've come up with, and therefore the execution capability. And in this journey, there will be the highs and lows, which means they're going to go through certain issues. How well they're able to be resilient. That is very, very important. So which means they will have vulnerability, but then how well they show the resilience, which means it's never a question of how many times we fall. It's always a question of how quickly we get back. I love boxing, and in boxing it is beautifully said that defeat is not declared when we fall down. Defeat is declared when we refuse to get up. So in the founders, what we are looking for is that resilience. And if they have that resilience and therefore they're able to show their vulnerability, we truly love them.
That actually gives a lot of perspective on what founders needs to have when they are talking to investors. But then the other part that I also see is they get a lot of rejections, right? As we all know, that's the reality. So a lot of times I see investors saying it's too early or it's not a fit. But what do you think are the common, like, real reasons behind when investors say no to these founders?
So first of all, you use the word rejection, Usha, and I think founders should always realize that the word rejection is only a feedback. And if the founders are able to sort of understand the feedback better, then I think they'll be able to come up with something which is even more greater. So if you ask me, why there is a no, or let's say why there is a statement of too early, it's because probably the investor is not convinced on the market study that the founder has done, what we call as market validation. So what happens is that in many cases, we would love those founders who actually care for the customers. Which means, they're looking for the feedback from the customer. They're looking to ensure that they're able to satisfy the customer. So let's say the founder is coming up with an idea, but no pilot users.
Yeah.
There's market validation, right? So what we will say, it's too early. That's what we will say. What is the meaning of too early there? Show me the traction. So when we say too early, somewhere the founder should also realize what feedback I'm getting. See, for example, I'm a pakka finance guy. I always say in God we trust, rest of them should bring data. So which means market validation is important. So this is where sometimes, founder makes a mistake. The second is, see, I always say that story is the heart of a startup.
Yeah.
It has to be real. I'm not saying it has to be a reel. It has to be real, but story is the heart of a startup, which means the narration, the vision is very important. That narrative is what, actually creates that excitement in the investor. For example, if the narrative, it doesn't inspire, it is kind of weak, which means there is a startup who is actually able to show some solid metrics, but then does not know how to convey the business. Too technical. You'll tell me when it's too technical, what happens in the mind of an investor? In the mind of an investor, the worry is, will I be able to understand this business better? And therefore, can I support the founder better? And therefore, probably the answer is a no. Again, I'm repeating, just because the investor, is saying too early or no, I think it is the duty of the founder to reflect on the feedback, follow up, show progress, revisit to ensure that they're able to again connect. I'll give you another concern. which we have, whenever, we look at startup. Sometimes we feel that, the team is not gelling. We
Yeah.
see counter views, coming from the team. When counter views come from the team, we are worried, is there chemistry among them? So when we have those fear, what is the obvious answer? We'll either get back or it's too early. So sometimes we may even, not be so comfortable saying no because we value, the time and effort of a founder. Sometimes we find that the founder are not financially disciplined. When we ask for the numbers, they are not able to tell us the burn rate clearly. They are not able to tell us, their run rate clearly, their revenue rate also clearly. Or sometimes, it's completely different. Their valuation is completely misaligned. For the stage they are, okay, I think their valuation, is sometimes too high, and therefore we find it, extremely difficult, even to sort of move to the next step. So these are some of the reasons, which makes us feel, that the answer is either you're too early or maybe the answer is a plain no. The only request, Usha, I'm making is founders should take it as a feedback. They should probe it politely. I'm repeating it again. They should probe it politely. They should extract the real reason from the investor over a period of time, if not immediately. Because at that moment, probably the investor is not, willing, to share more. But whenever they are meeting the investor in different forums or platforms, ask the real reason, use it as a feedback, and then come back. I think that's the only mantra, how, they can show us the conviction. So I'm going to make this statement. I never believe in the vision. I believe in vision plus conviction. If that the founders have, I think those founders are the best founders.
That's pretty strong. And I'm thinking from a founder's perspective, a lot of founders, when we talk about metrics, what metrics are important to investors?
So the metrics are very simple because let me begin by making the statement. If you can't measure, you can't manage. So what is a metric? A metric is helping you to measure yourself better. So I'll continue that statement. If you can't measure, you can't manage. If you can't manage, you can't control. If you can't control, you can't direct. What cannot be directed can never become business. That's our worry. So what we are telling the founders is measure those 5 or 6 or 4 or whatever you think is the appropriate metrics for your business. For example, if it is a SaaS company, I think we would want you to tell us what is the CAC, the cost of acquiring customer, what is the customer lifetime value. We'd want you to tell us what is your for example daily average user, monthly average user, weekly average user, and therefore what is the conversion rate, what is the retention rate, and therefore if there's a retention conversion, what is your monthly recurring revenue? How does that translate to annual recurring revenue? If there is a churn, tell us the churn. Show us, what is a repeat. Show us, that there's only a traction but not a revenue, which means how many users are now loving using it. And therefore, what are the chances, that so many, could be converted into real customers. Tell us, what is your margin? Are you really making profit? What is called as unit economics. Yeah. Show us, in terms of, when you're going to get into break even and therefore the profitability. Show us, even in terms of, what's the runway of the cash that you have raised, the money that you have raised, how long will it last? Show us your burn rate, how much of, cash you're burning. Look at this. Have I told anything complicated, Usha?
No.
Jo bhi dhanda, whoever is doing dhanda, jo bhi dhanda kar. I think this should be something that should be inside the system.
Absolutely.
And therefore, the only request that we are telling the founders is don't get bogged down, or don't get, deterred, or even intimidated when somebody said metrics. If you can't measure, you can't manage. That's it.
And when they are coming to these meetings, I see obvious hesitations are always there, right? You are pitching to an investor. So, of course, the power dynamics is always there. What are the things that, founders usually feel shy to ask, but they must ask the investors?
I think if I was a founder, I would not hesitate to actually speak to the investor, not ask, speak to the investor saying that if I don't perform well in the next 18 months, what is your response? And I think the response from the investor should make the founder much more comfortable in terms of, how the investor, is even looking at the business. For example, the investor says, hey, how can that happen? Because we want to have routine meetings, right? So in the routine meeting, be happy to share the bad news. Now look at the statement. I think the founder should feel even more super excited because he can now trust the investor in terms of, even sharing things, that are not going right. If you ask me, that has to anyway be the natural way of, dealing with the investor. So one of the things is, can you align with the investor in terms of the expectations so that there are no surprises? I always make the statement that clarity today prevents conflict tomorrow.
Absolutely.
So
Yeah.
I think if the founder is able to work with the investor and have this ability to appreciate the expectation that the investor has, I think that question they should always ask. The second I would always want the founder to ask is, what are the key clauses in the term sheet that the investor will not budge? For example, like if there is a valuation, are they happy, to accept a floor also? Because the floor is something that protects the founder. Or the investor, not excited about, having the floor. Investor would always love to have a cap, but not a floor probably. So, sort of understand whether that happens. What about the protective rights? How focused they are in terms of, having the right on the ability, to invest further, what we call as preemptive right. I think what I'm saying is that, this clauses, founders cannot be ignorant. They have to ask this question to the investor that what is it, that makes, this particular transaction a deal breaker if, you're not able to agree to it. The third is a beautiful question, Usha, which I wish founders asked us a lot. What is it that you can bring beyond money? Because I wish founders looked at us as partners and not mere funders. I think look at a guy like me, gray hair, lot of experience. And I think if somebody only understood, what is the sort of background I carry, I think rather than the check size, if they looked at me, as somebody, who can partner in their journey, that would be great. And I'm not just speaking about myself. There are so many amazing, investors who are capable, of even supporting the startups. Therefore, my message is money is commoditized today. It's only a commodity. But trust me, the guidance and support is never. The guidance and support should be the first mantra, for a founder and not money, because money is a commodity, but guidance and support is not. So this ability to even find beyond money is what I think founders should ask very openly. That probably will help them big time.
Absolutely. And when we talk about aligning with the investors, a lot of questions come where founders, because right now there are a lot of investors at different stages, but what are the investors that would be relevant to them? How to determine that?
I think the very first exercise that any founder needs to do, and I've been saying this very vocally, in many of the forums, do homework on the investor. Because the first thing, is the fitment. If there is no fitment with the investor, I think you're only looked at the financial aspect and never looked at the strategic aspect. So the one big request is please remember investors are plenty. Okay, and therefore there is a higher chance, that you may be successful in raising the money also. But the question that should precede before the money is raised is, have I done enough study on the investor even to find out how compatible, my relationship with the investor is going to be? Because if I have to use, a word which is very relevant, to our family, okay, in the world of startup is, it's like a marriage. It's a family. Okay. Somebody you're bringing into your house, so-called, investor. And therefore, the only request is that, if they are able to study the investor, understand why they are investing, where they are investing, what is their level of depth that they want to go, what level of, board representation they want to have, what is it, that they can bring on the table beyond, the money, they anyway have, because they're running a fund. I think this exercise is something, the founder needs to do. Secondly, it's not just looking at the investor, it's looking at what stage they invest. So many founders simply spray and pray because they have seen an investor. Okay. In their eyes and mind, only money, is visible.
Yeah.
What is not visible is what stage they invest. So probably if you come to me, where, I'm not a late stage guy, okay, I will never even want to, look at that investment. Or let's say I'm a guy who does not even look at pre-revenue. I would not be even interested, in terms of looking at your startup. So I think the stage is very, very important, that matters. And the third, which is very important for a founder, is if they're looking at a venture capital firm, look at their portfolio and see if there can some benefit that can come out of the portfolio. Either you are benefiting them or that portfolio can benefit you. Because if you're able to narrate a story which is along these lines, I think you become, a visionary. Because you're able to think beyond just that particular venture capital firm. You're able to think, beyond in terms of what opportunities are there. And I think this skill set is something, that the investors love a lot. And therefore, I think founders have this duty to do a research on the investor, understand what stage, they are investing, but more importantly, what is it that they bring on the table beyond the money? What is their capability? If they do that, I think, the chemistry will be a lot better, because again and again, I'm repeating this. We are not funders, we are partners. Somehow, if you could find a right partner, I think the journey for both would be great.
Yeah. Absolutely. I mean, I've seen that with great investors, startups reach like altogether a different level.
Very true. Absolutely. And even in my cases, there are not many because you can't work with many startups deeply. There's a limitation of time and also, understanding of the segment. So even in my case, there are a few, where I always feel, grateful that we got that opportunity. Probably the chemistry worked.
Absolutely. And I see a lot of founders just going by the hype of raising investment, even if they are doing pretty decent revenue. So, one of the questions that really comes up is when does these founders start looking for funds?
I think the answer, depends in terms of, what is the ability of the founder to show their execution skill set. For example, I don't know, Usha, I know whether you've come across the situation. I think in some of the VC firms, who are probably much more experienced, one of the very common questions they ask the founder is, let's say the founder is asking for $1 million. The question from the VC is, if I give you 2 million, what is it that will happen to the business? Will it scale up, much more faster? Will you be able to do something, much more better? So I think if you ask me the question, money can be asked at any point of time. The only question is, are you ready as a founder? Because the money that comes to you is not coming you to sit in the bank account of the startup. It is coming to ensure that you're able to show certain traction, show certain growth, certain way to show that you can achieve certain milestones. And if it's always milestone or growth or traction or some purpose driven, that's what. That's why whenever we are asked for money, we always tell the founder, show me that pie chart, which tells me where the money is going. And do you have a financial plan which actually supports it? Or is it just for the sake of, presentation? We are very open about it because end of the day, it is so easy to show a number which is not actually backed up by a real business plan. I always say plans are worthless, but planning is everything. Because when you are planning, you're actually talking to so many other ecosystem players to ensure that you understand your business far better. And therefore, money can be asked anytime. Only question is, are you ready? Are you ready in terms of using that money to show a purpose? The purpose could be better traction, it should be growth, should be acquiring more customers, or probably if you're in the world of impact investment, you're trying to, show that, you're able to do a lot more impact in the lives of people, even if the profitability is not there. But you're able to, sort of reach to many. I think that should be the objective. The second answer is the founders, if they are actually doing very well with their revenue, they should also ask this question, do I need the money really now? Because trying to bring somebody into the family also means that no, you have to share, certain rights and responsibilities with them.
Yeah.
Is that something that is required? So I think this is a smartness of the founder. If you ask me, they should look for smart capital, not capital. If it's a smart capital coming with a lot of other benefits, I think it's a great virtue. If they're simply looking for capital because they feel that okay, if I have money, which is even if it is idle, but it makes me look good, I think that is not a fair way of looking at capital because equity is the most expensive. Look at the return expectation that investors have: minimum 20%, 25%, 30% IRR. Just imagine. It's the most expensive, which sometimes founders don't realize. So I think don't chase money, chase a purpose, and I think that will be beautiful.
That was really insightful when you, said it. So, I also think about how should early stage founders think about valuation, specifically in today's environment when people just come up with like 250 CR of valuation. So, how they should be valuing it.
So one of the requests, that we have been making in recent times, because if you know the year 2021, it was kind of quite abysmal in the sense the valuations reached, so high, and sometimes we also felt without rhyme and reason. And the year 22, 23, 24, 25, and even now you're seeing, that the momentum is actually becoming much more sane. There's a lot of sanity that is prevailing, which means at the moment, if you ask me, the valuation is based on the fundamentals. It's on the core values. And therefore, my request always to the founders is think of value creation rather than merely the valuation. And if you want to come up, with a valuation, please ensure that, you're able to have certain basis to even justify that, why, that valuation is up to a certain level, which means back up that valuation with a story, not merely a number. And when I say a story, it's a real story, not a reel. Again, I'm reminding, because what I mean by story is, have you looked at certain comparables? Have you looked at certain market? Have you looked at your own unfair advantage to ensure that you're able to show that, which means have you even done a benchmarking, okay, to show why you're powerful. Sometimes I see the founders could have a negotiation power, okay, they can even use that to say why they think they are slightly above what the market is. And I think if they're able to show us even their ability to prudently manage the business, the cash flow, the expenses, I think all those are brownie points for us not to negotiate too much on the valuation, but probably agree a win-win situation. So I'm not saying that whatever founder says will be easily accepted. I'm not saying that what we want, would be easily, accepted by the founder. But I think if you're able to show this manner in which, you're able to justify the valuation because, you have certain unfair advantages, probably, it is fitting well with the investor in terms of, what size, the segment, the industry, that they're looking at. I think that, would be very, very valuable. So if you ask me, the only request I'm going to make to the founders is if you simply over optimize on the valuation, you're going to create a problem for you later. I know many startups who raised money at a super high valuation, and trust me, after the next round, they realized, that they had to go on a down round valuation, which actually is not good, for the startup or the founders.
Yeah.
So my only request is, be very, very sensible and practical, because trust me, valuation is about how you create trust with the investor also. Because what the investor is looking at, I've invested at this level. What are the higher chances, that the next investment can go at a better level, bigger level? And therefore, if this win-win ideology is there, I think it would be a great success.
Absolutely. And another word that is very close to founders' heart is dilution. How much dilution they need to look at the stage of seed, because it is gonna impact the further future rounds. So what is the right percentage?
I think the answer is quite simple. There is no magic number. I'll be very honest with you, because I've invested in more than 70 startups. I'm part of 10 funds as a limited partner. I run my own fund. I keep evaluating startups all the time. And I've realized now that there's no magic number to this. But let me also say this. The first fundraise is always quite expensive. And therefore, if you need some sort of a benchmark or a range, I would say that if you're raising the fund for the first time, try to see if you can maintain it between 8 to 12%. Because if you just offer a 4%, 5%, I don't think anybody's going to get super excited. If you would offer beyond 15%, 18%, then probably the next round, you will be diluted more. So I think what is important, I'm trying to say, is that try to make it attractive. From my experience, I think 8 to 12% is what I see as an attractive sort of dilution. That is what I'm typically speaking. But what is important, Usha, is this. I think the founder motivation matters, whom they are bringing in. Let's say they're able to bring in somebody whom they believe is going to add much more significant value. Why would I not give them a 14, 15%? Which means whose homework it is? Founder's homework. How much the founder has well understood the investor, the capability of the investor, the network of the investor, the also, the so-called ability to bring further monies. Can they also help in the next fundraise? So I always say that network is a very, very important word, because networking is not about connecting with people. I always say networking is connecting people with people, people with ideas, people with opportunities. If that investor is able to do that, if they're able to show, a multiple way by which the connections can happen, I think the founder should feel very, very satisfied, because probably the growth would be faster or the support would be much more, better. That's one. Second, look at what the investor wants also, to feel very confident about a particular stake. Why am I saying this? If it is too little as an investor equity, they may feel under incentivized, right? So find out, have a dialogue, have a conversation, deliberate to find out, what makes it as a situation where both the parties are happy. And that's the only way, you can actually, that's why I said there is no magic number. But finally, I'll say this. All investors know that they can't take a sizable stake, because the next round becomes difficult. So they always are having in their mind that if founders dilute too much, the later rounds will become difficult. So they always want to ensure that there is pretty good headroom for the next round. So trust me, investors are also savvy. The only thing I'm saying is that if the founder is able to find an investor who is a great match, it's something that can only happen with a lot of homework. Okay, it doesn't happen in a jiffy. And secondly, if the investor is also comfortable, in terms of the feeling that there is a bit of incentivization for that particular equity, I think that's the only way it works. So no straight answer, but as I said, typically in the first round, it's 8 to 12%.
Understood. And as a fund right now, what sectors or what areas are you really excited about?
So at the moment, we're looking at sustainability. And why sustainability? Because I think there's so much of talk that is happening in terms of ESG, in terms of SDG, the Sustainable Development Goals. But the reason for us is slightly more different. I mean, we all come from much more age, and generations. We are the later generations. But in our generation, Usha, we always used to make the statement that sustainability is about doing less harm. So if you did less harm, that was a huge tick, saying that, wow, these guys are doing great. But I've realized that in today's generation, which is all the millennials and Gen Z, I think the mantra is different. Sustainability today is about doing more good. And that's why, I think the millennials, Gen Z are super excited about sustainable startup, which means you're able to now attract conscious customers. People who are conscious about the economy, the ecology, the environment, which is actually a great sign. So what I'm trying to tell you is that sustainability is one area, which, is something that we are looking at. And the reason why we're looking at is we don't want simply the startups to put the boxes, simply tick the boxes. We want them to have or do something which creates a positive impact that can transcend generations. If they are able to do that, such is the sustainability startup that we're looking at. So I'm not using this word sustainability loosely. What I'm saying is that if they're able to create an impact that can last generations, I think that is very, very interesting. Look at waste management, look at water conservation, look at, certain sustainable supply chain that is required for today's jamana, because everything, seems to be the last mile. So how do you ensure, that it is also sustainable? These are something that we're looking at from a sustainability angle. The second for us is definitely the world of AI, ML, and the deep learning. And when I say AI, ML, deep learning, we are being cautious here. What we are trying to say is that we do not want the simple AI, which is called the ANI, the artificial narrow intelligence, because it can only, perform what you're telling it. We're actually wanting to find out if there is a real AI ML that can even learn. And therefore, it can do things which is actually helping the community in a much more better way. So are there certain startups which are getting into the next level of AI so that there is a superior performance? There's an ability to even, act in terms of providing efficiency, to the humans. So one of the things which I've always felt is that this AI can either be a enabler, what I call as a tech enablement, to the startup. AI can also bring efficiency in the startup, or sometimes, AI can even surpass the expectations. So it is not easy, but those are, some of the startups, that we're looking at, because for us, the statement is very simple. AI is not the next wave of technology. I think it's a tsunami that is and changing everything. So it can change everything. The only question is, do we have that ability to even find such startups? So we are not the real expert. We also have subject matter experts with whom we are dealing to get, such startups. The third area is something, we are looking at health tech. What I mean by health tech is today everything is becoming personalized, everything is becoming a convenience, everything is becoming accessible. You want medicines, it comes at your doorstep. You want to speak to a doctor, there is telemedicine. What I'm trying to convey is that if there is a technology which is in the healthcare space, which is making our life much more better. See, I spoke about personalization, right? You will be surprised. Today, there are skincare companies who are looking only for personalization based on the skin tone of the customer. There are this skincare companies which are looking at anti-pollution products. Okay, so that the skin, skin is much more, better. There are this colored contact lenses, which actually match, the situation that you're into. It's crazy world, but it's called personalization. It's called customization. And then, of course, if it is also accessible, that makes life easier. So these are the three segments that we're looking at a much more bigger way.
Okay, so you're basically looking at sustainability, health tech, AI/ML, or any deep tech, and
Right.
customized cosmetics or skincare, basically.
Or anything that is customized, anything that is customized for the consumer. Okay, and if that space resonates with us, I think we would be super excited. I think what we are trying to convey here is that startup should be in a position, to come up with an idea that is executable. It's not just an idea, because we are tired of so many ideas. And therefore, what happens is that when we hear an idea, we of course give our time and attention. I'm not saying that we will not do that. We do give our time and attention. But trust me, it doesn't move to the next level of, making us feel, whether we can invest in them. And that is not a good sign for either the investor or the founder. And therefore, the request that we make to the founders is you be agile, you be adaptable. please ensure that you should be ready to pivot based on what feedback you're receiving, not just from us, from the customers.
Yeah.
We are telling the founders that you focus on actually creating a real value so that you can solve pressing problems. See, it should be pressing problem. I say painkiller. It can't be vitamin or candy.
Yeah.
What we're telling the founders is that you embrace technology and innovation, which should be central and core to your startup. It should be either a tech enabler or it should bring efficiency. Don't tell me I also have AI. Because there's a joke, today in the world of startup that if in a deck there is no AI, we'll reject it. So it cannot be just tech. The tech has to be an enabler. The tech has to bring some efficiency, or let's say the tech has to surpass, what, we can even imagine. And of course, we want the founders to prioritize on sustainability, on inclusivity, on socially responsible, sort of initiatives, because I think that's the flair, which we are looking at. So that is the segments, which is of interest.
Understood. And when we say early stage, is there any particular number of revenue that they should be doing for you to be interested in them?
So whenever we say early stage, what we are basically explaining is that they have traction but not revenue. That's what we mean by. So let me define what is traction. Traction is something that the startup is doing, which the users are able to value and therefore are willing to use it. There's a willingness to use, not yet willingness to pay. So which means you will see that these sort of early stage startups would have pilots, POCs, prototypes, MVPs. Some of them could be paid pilots, or they would have, early adopters, evangelists, who may be, accepting their product or service, and therefore they may be paying. But the revenues are, quite, low. It is yet to show, significant monetization. Okay, that's one thing is called early. Second, what is early? The early is you're yet to find out that product market fit. You've understood the problem. You have gone deeper. You came with your execution ability. Okay, and as a founder, you're relevant to the market, but the product is yet to be fully accepted, by the customers. So what is product market fit? Product market fit is building something that the user is able to give a feedback. Because only when somebody uses it, you will get some sort of a response. Hey, acha, it's very good. Or no, something is not, gelling with what I'm looking at. So building something that is able to get the feedback of the customer. So that's the second in terms of what is early. The third is early is probably they have been able to raise only smaller monies, not bigger monies. So which means it's friends and family. Probably, there are some angel investors. Okay, probably, they've been able to meet a micro VC and, convince them. So the monies are yet to be, raised in a significant way. The fourth point is, because they're at an early stage, okay, they have not been able to build a significant team also, which means they're still hunting even to find a co-founder, okay, or even the next line of, team members. So these are some of the signs of how we look at early stage, which means it's not just the revenue, it's the situation, the stage, what segment they are in, what is their ability to appreciate the market, and therefore, how well they can move to that product market fit sooner.
Understood. And so talking about, usually founders, when they are raising, they are hunting a lot of investors. What can be the right way to find the relevant investor? Is it, online, be it LinkedIn specifically? Like, what are some practical tools that would help them reach out to investors?
I think today the startup ecosystem is very active, and you will see a lot of those investors attending the events either as panel speakers or jury, or in whatever format. I think one of the requests I would always make to the founders is attend a lot of these events, because sometimes when you physically meet the investor, okay, and let's say you're lucky, to get few more minutes, you can actually ask them, their thesis. You can actually have this elevator pitch done to them and even find out what sort of feedback, they're getting. So the feedback could be simply, they don't invest in that segment, or the feedback, could be a real message, in terms of what they believe, the startup should do. Or the feedback, could also be, that they will connect to an analyst so that, they can discuss further with the analyst. So one is be in forums, where you see this guy is active. And I think that's the best way of catching their attention. LinkedIn is a great way by which, you can connect with the investors. Only request is do not immediately share the pitch deck. Share a one pager or maybe something closer to a one pager. Where you have done enough in terms of use of minimum words, but creating that interest. What we call as a teaser. Can you tease them, to, sort of get back to you, try that. The third format I would always say is that, this cold email is not wrong, but in the cold email, please don't simply ask for money. Mention that, you have seen the portfolio or you have seen that investor speaking in a forum, you liked, a particular thought, that the investor has said. and then explain about your business and say that no, you're lacking A, B, C, which you think the investor could sort of befit or bring further strength to the startup. So if you're able to show something which is more meaningful beyond the money, then I think the investor would be definitely excited to at least respond back to you. The fourth way of connecting with investors is look at the websites of the venture capitalist and find out which analyst is sort of looking at what segment, and then mention that I understand that you're looking at ABC portfolio. Okay, and mine is a portfolio which is exactly not that, and therefore that's a good starting point. This is where I differentiate. And therefore, is there a way, that we could connect over a cup of coffee or a phone call or a face-to-face meeting, whatever it is, So I think there are multiple ways. I've just given you 4 ways. There are multiple ways, by which a founder could be a hustler to ensure that, they're able to move and, meet, the investors. But then don't do that without doing the homework about the investor. Then you're only spraying and praying, which I don't think is good for the founder, to get the right.
Yes, because it also takes a lot of time and energy from the founder's end to like also take out time from doing business into following up and chasing the right investors. So another thing is when such deals are happening, and as founders, we always imagine what's going on the other end of the table, right? So how are you looking at exit timelines when you are doing the deal? What are you thinking while this deal is happening?
As a fund, I have to be very true that we always look at exits, but we are very sensible. We know that the exit won't happen in a jiffy. It may take 4 years, 5 years, 6 years. Could be longer because not every startup is the same. So you can't put in the criteria same for every startup. But then the exit is only a thought. What precedes the thought is, what is it that we can even work with the startup to ensure that we are able to support their growth journey? Because if they grow, it only means that they'll be able to attract further capital or probably even an acquisition opportunity. And if they grow so well, probably they are a good candidate even for an SME listing or maybe a main market listing. So I think what precedes definitely the exit thought is also what sort of support that we need to give. And this can only happen when there is alignment of values. Okay, because the values on both sides need to be much more clearer. We'll only get excited when we see that there's a lot of transparent communication that is happening with us. Because if we want sort of even present them to the next set of investors who are much more bigger, we should be more comfortable that we understand what the startup is doing. So I think the way by which the startup is able to show us what is happening with the business in the form of information, MIS, the documentation that is required, I think that would help us a lot. And I think there must be a way by which the early traction should move to a next better level of milestone, because that is when I think the founders themselves will feel confident in terms of the acceptance of their product or service by the customers. So I think what we are trying to do with them is even help them on the market access, help them on the GTM, because we know that if they're able to get more customers, more revenues, that itself is going to be a greater sign for us to look at exit in the future. So what I said now is that exit is always in the mind, but there are a lot of other things that precedes this word exceed in terms of what support that we can give to the founders. In fact, we love those founders who are very authentic, show their grit. And with such founders, we take that extra mile, even to ensure that we are able to work with them closely. And you'll ask me, what about the other founders? The other founders, what happens is that, you don't want to spoil the relationship. So you want to still give them that autonomy to do what they want to do, knowing very well that in the board meeting, in a nicer way, how we can point out that if only few things were done in a much more better way, how it would have benefited the founder. Because the chemistry is something that is very important. It is not spoken much in the world of the startup ecosystem. A lot of people speak about founders, how well they have done, or investors, how well they have done. Very few have spoken about the chemistry that works. In fact, I always remember about Freshworks, where Shekhar Kirani, investor from Axel, and Girish Mathrubudam, they struck a chord. And I think that was one of the reasons why, I think it helped the business to grow despite certain ups and downs. And I think this relationship, between the investor and the founder is more of a partnership. If that can happen, I don't think that can happen with every startup, but at least, with few startups could become a great example to the others. That if only, we are amenable, we are flexible, adaptable, I think the success rate is much more higher.
Absolutely. And you mentioned that you have done more than 70 investments now. Are there any investments where you regretted doing?
I think the answer is, there are few. But if I have to take one example which is vividly in my mind is, I invested in a particular startup where I went by the greater scale of the GMV, what we call as gross merchandise value. And somewhere, like I did not focus on the unit economics, which means the margins. So the business was scaling, but it was abysmally, bleeding money because the margins were so low, it was not able to absorb the cost. So what happens in such cases is that, the growth can be seen, but to grow, you need further monies. But one of the concern we had is that when will that business get to break even? When will that business, because a lot of promotions continue to happen to get that growth. So that is one, maybe, an example that I can share where I felt, so sad, that, despite having that ability to evaluate, there was a miss.
Yeah. Those are kind of learnings. What makes you even much better and experienced in
So I
that.
always say, Usha, that either we win or we learn. And I always tell myself that my learning velocity, if it is that is better, I will still survive. Because one should never have regrets about having made an informed decision.
Yeah.
I made that decision, it was informed decision.
Yeah.
And therefore, you should never feel regret. And let me also tell you, startup success is rarely immediate. It has to be somewhere within our system. And I always tell this that angel investment is never for faint-hearted. Therefore, like we need to develop certain ability to evaluate startups. I'm not saying that you're just putting money without even evaluating. You've done your enough bit to understand. If things go wrong beyond that,
Yeah.
either it was a bad call or maybe an external situation, or better learn from it and become better.
Yeah. Yeah. It is actually a very interesting concept in psychology when you said it goes for all kind of decisions, business or not. If you have taken an informed decision at whatever period of time, then you have to trust your past self.
Exactly. In fact, I always say that, it's very painful, I understand, but I always say that pain, add a plus, and then say reflection. That is equal to progress. There's a pain, but if you're able to reflect on the pain intellectually, not emotionally,
Yeah.
I think probably you're going to make progress because I don't think, any one of us will not make a mistake. We will, but the beauty is that are we able to learn faster from it? Are we able to become better? And I think that's only mantra.
So I think it goes a lot in business because there would be failures. There will be a lot of things that would not work. But as you said, if founders are reflecting on it, on what went wrong, they can really improve over it and not repeat it in future. Maybe do it differently.
Very true. 100% agree, yes.
And as you said, like tsunami of AI, it's everywhere. It's affecting everywhere, right? But as an investor POV, how do you see investments changing or the ecosystem changing because of AI?
I think what AI is doing is that it is able to give, pointers to the founders to say that some of the routine, mundane jobs, which needed a lot more people, they're now able to do it much more effectively, with the help of, AI.
Yeah.
For example, in the world of robotics, which sometimes, could be quite risky in terms of what, that robot can do, if you had human to do it. I think the human, element risk is eliminated by having, a robot, which can actually, perform some of the riskier aspects. So look at how technology is not only eliminating some of the routine jobs, it is making us much more better in terms of who we can be. Second is wherever there's a risk, today, robots, can help in terms of, even eliminating, that risk and probably, do it much more efficiently. I think the third thing which I see technology doing today is it is making us efficient in a much more better way. I mean, look at the LLMs, which are there. There are plenty that are coming up, Servam, today has become, such a great, name, after the AI, conference that happened in Delhi. What I'm saying is that I think if we use LLMs, we are able to see that we are able to do our own task much more easily. We are able to understand a concept much more better. And I think if that efficiency, is actually coming into us, trust me, how much better we can become. So I always say that AI will not take away the jobs. AI will take away the jobs of those who are not willing to learn AI. If you are willing to learn AI, the only thing will happen to you is you're becoming actually better. For example, I, love doing business valuation. One of the techniques that we use is called discounted cash flow, a mathematical, sort of, usage, to come up with a valuation.
Yeah.
There are today LLMs, which can actually throw the valuation if you only prompt it the right way by even telling you what is the scenarios, what is the sensitivity, what assumptions if it changes, what happens to the numbers in a much more better way. what it is doing is making me now feel, much more better in terms of how I can improve my understanding of how I can move to the next step of, arriving at that valuation. So it brings efficiency. And if you ask me what is technology doing, as a much more better way, is look at some of the industries where I think that technology is required. Look at surveillance. Today, war is happening. What is it that is used for a war? It is all the drones, right? The missiles, which what is driving those? It's a technology, right? Look at how many Indian, startups, are doing such a great, support, to the defense of the country, either in the form of surveillance or drones, or some of the, space, tech that is required. So I think technology can actually be a significant differentiator or disruptor if only we are able to use it rightly. So it is in our hands. If I misuse it, of course, it can, lead to, so many, bad news. But if I use it the right way, I think it is only going to make this economy and world a much better place. But the constant, statement in our mind is you don't just leave to the technology. There must be human in the loop. Many of us are missing on that. When the human in the loop is missing, that's where no issues happen, because you can never replace the human intelligence. I always say that artificial intelligence can only be a support to the human intelligence. It can never replace it. The only problem which I'm saying is that if the human in the loop is absent, that's where technology starts doing things which we start blaming technology as overpowered. We never gave it the right attention.
Absolutely, because I'm seeing a lot of specifically MNCs who said that we can fire a lot of people. Now they're understanding, no, at senior level, they still need humans to run the whole system. So, yeah, again, senior hiring is again picking up. So people are understanding that the human mind is definitely needed in between.
100%. Absolutely, yes.
And talking about all the investments that you have done, talking about the positives of it, what was the biggest investment that gave you the maximum returns?
So it is very interesting. Fintech is one segment which I thought was losing its charm. But one of the exits, I got, the fintech space was a 7x, which is quite a, healthy, sort of output, for me. And that was a surprise to me because I was expecting something, on the deep tech side, to give me a much, significant return. Probably, time will answer whether I'll get a much better on the deep tech. But that has been, one of the excitement. I've got, 5x, 6x, 3x, sort of returns in other cases. I've lost money also because that's the journey. So if I have to say it very jokingly, I used to say that one win can take away all our sins, because that's the beauty of the world of startup. There's a book by Sebastian Mallaby. It's called The Power Law. And in that book, Sebastian Mallaby says so beautifully, it is a smaller number of investments that generate majority of the returns. So somewhere this Pareto law can also be constituted empirically, that the law of averages, if it is an upward curve, you actually do well for yourself.
And we already know that you have done your investments in companies like very well-known companies like Vedantu, Agnikul, Chai King. So did they come to you? How did you find these founders? What did you see in these founders?
So the answer, Usha, is that even investors need to put a lot of effort, to be part of good startups. It's not that, the founders would come to you. So there's a lot of, effort, that even the investors need to do to ensure they're able to pick up, the good startups, because those startups, whom we, are able to sort of look up to, okay, also means, that, they already have a lot of attention from other investors. So for you to be part of that cap table, you have to do enough to ensure that you get, the attention. For example, one of the portfolio that we have in our fund is Bombay Shaving Company, which is quite, quite a huge company because everybody knows Bombay Shaving Company. Yes. And the only reason why we were able to get to that is via another network. And then when we said that, we'll be able to sort of support in terms of the Western Europe distribution, okay, because, of my past experience, that sort of, led to, some sort of a connect. There's a lot of effort that investors also need to do to ensure that, they're part of the startup journey. So it's never, the other way. A lot of people think that founders do a lot to get to the investors. Yeah. If you're actually, getting you're being noticed, in the market because of whatever you're doing, trust me, investors will come and follow you, would want to have a conversation with you.
Yeah, I mean, that is the kind of situation that every founder dreams of.
Absolutely. And it calls for a lot of help. It doesn't come, just because you're doing what you're doing, you have to do beyond what you're doing. It calls for significant effort. In fact, a massive, effort is the only reason why the startups, can scale up to a significant level. it has to be massive. It can't be effort also. It has to be a massive effort.
Yes. So, time for some quick questions. So, one investment decision that you wish you had made differently.
I think the one that I gave as an example, that where I went by the gross merchandise value, not the unit economics, the margins. I wish I had also looked at the margins better, because I know that the founders are great. It's just that that segment calls for a lot of money even to scale. And I think very few investors have got that ability to keep on pumping in the money. So probably there, if I looked at the margins, I would have advised saying that lower the growth, because it can help you have your margins better. And therefore it's not always a question of the revenues. It's also a question of profitability. It's also a question of cash flows. I always say that sales is vanity, profit is sanity, but cash flow is reality. So I think that belief I always had, if it had come at that point of time, would have been wonderful.
Understand. So, what is seemingly a boring business that you bagged recently is performing exceptionally well right now?
I'm not a fan of B2B businesses, but one particular B2B business, I know it's a boring business, but trust me, it is able to help the customers to be compliant. It is able to help, those customers to ensure that they are able to invoice on time and even send reminders on the collection. I know it's boring. Compliance is boring. Invoicing and then reminding on this is boring. But trust me, I love that startup because that's steadily growing. And many, customers don't name the startup, but I've always, named the feature of that startup. So it is sometimes not known by the name of the startup, but the feature that they have, for reminding the collection. That itself is a great sign, about that startup.
Absolutely. And has any founder said no to you? And if yes, then why?
There are instances, Usha, because you're not living in a world where you can dominate all the time. Okay, the market dynamics are very, very different. I still remember one of the fintech founder saying no because I was not able to agree on the valuation. And trust me, he was able to raise the money later at the same valuation that he had in mind. And that's why I sort of learned from him. I learned the statement about a founder that sometimes saying no when the founder does that. So when a founder says so sometimes saying no, I think it's the boldest yes that you're telling yourself. Because somewhere you're so convinced that you will get there. That's why, I always say this: vision is not enough. Vision plus conviction. You're convinced that you're definitely going to get there. That's why you need to have that hustler mentality. Otherwise, it doesn't work.
Understood. And so if you're traveling to let's say a founder's pitch and you only have like 20 seconds to see a pitch deck, what would be the slide that you will check first?
Always, in fact, in my conversations to Usha, I ask them first, what is the problem you're solving? So the first thing that I always look at is a problem statement. Because I always make this, statement very, what is the right word? Very forcefully in the minds of the founders, saying that a problem well defined is a problem half solved.
Yeah.
Because if you can define the problem well, go deeper, you'll be able to find that the problem is actually large. And if the problem is large and therefore the market is also large, you'll be able to find that many customers for you to grow, which means your revenue run rate in the next 3 to 5 years would be better. So I always tell the founders, you have found the problem. Is the problem popular? Is it urgent? Is it growing? Is it expensive? Is it mandatory? Because those are the signs that are telling you that you're going to come with a beautiful painkiller. Because there is a pain. So my first thing which I always want to see is the problem statement, how deep they have gone, and then the solution.
And last question, is there any a book or a resource that you would suggest to one, a founder, and another, an aspiring investor?
I think to the founder, there is this beautiful book by Eric Ries, which is called The Lean Startup. I'm sure you've heard of it because it's a very famous book, The Lean Startup. The reason why I want to refer to that book is very simple. There is this beautiful concept of build, measure, learn. You build something, then you measure what is the output coming out of it, and then you're learning better. If the output was good, fantastic, think how we can make it great. If the output was not so good, now you learn how to make it better. So this concept of build, measure, learn is something that I always apply even on other things of life. So the lean startup basically spoke about a very beautiful concept. It says success is not about delivering a feature. Success is about learning how to solve customer problem. So Steve Blank, who was considered the startup guru, he always used to say that building, a product or service without knowing the customers is a wasted effort. So many startups, they are very focused in terms of how do I build a product or a service, not even knowing whether that product or service is going to be useful to the customer later. So success is not delivering a feature. Success is understanding how to solve the customer problem. That is what, Eric Ries said in the Lean Startup. And why I love this is because he has this beautiful diagrammatic representation. He used to say that you don't find the customers after developing the product. You basically come with something called MVP, the minimum viable product. You iterate, pivot, and then, you get the feedback of the customer. You ensure that the customer is absolutely, sort of convinced, and then you sort of, go and find the real customers. So that's one book, for the founders. The second book, I think I already told you, The Power Law by Sebastian Mallaby. This is very relevant for investors because empirically, there's a lot of data which shows that it's a smaller number of investments that generate majority of returns. This is not for a feel-good factor. See, somewhere we have to realize, that startup world is risky. There are a lot of these headlines that say, right, 70% of startup fail, or even, more than 70% of startup fail. I think one should realize, that there is a lot of failure rate, and the failure rate are so many factors. It's not just, some 3 or 4. There's going to be some 20, 25 factors. But the point is that now that you have empirically understood this, only try and become better in the art of investment. If something fails, take it as a lesson. Don't just brood or regret, why it happened, because that's not the journey you are into. Startup success is rarely immediate. That's a very important statement that we need to say.
Yeah, that's why founders need to be really patient and perseverance needs to be really high in order to choose entrepreneurship even.
Very true.
So, and so that's from my end. But if you have any final message to the founders, please do share.
There's only one message, Usha, and this message is there's a significant value, that is always there for integrity. And I always say that, transparency leads to trust, and trust is that currency that can actually unlock the investor confidence. So why am I saying this is because I think Warren Buffett said something so beautifully. Whenever he interviews, this is what Warren Buffett used to say. He used to say that I look for 3 things in a person. And he used to say that the 3 things are intelligence, energy, and integrity. And then he makes a statement. And if they don't have, the last one, which is integrity, the first 2, which is your intelligence and energy, doesn't make any sense.
Yeah.
So one of the requests which, I want to make, not just to the founding community, to investors and probably, in general, is that our authenticity has got significant value. So it's not always, that we need to show, that we are always doing better. Then I think you're under a pressure of being on a treadmill. It's only a treadmill, where, it becomes like a routine, sort of way to only try to appease the world. I think your authenticity is something, that is the defining factor, because our life will not be straightforward. There will be, ups and downs. How resilient you are, how transparent you are is going to make a significant difference. And that's the only message, I want to say, because this is something that has to be very closer to our heart. And trust is the currency, which will actually unlock the investor confidence.
That's really powerful. And honestly, all the suggestions, all the insights that you have shared today, like I can only imagine how much a founder can learn from it. So thank you so much. Thank you so much for sharing all this and for your time.
Thank you so much, Usha. Thank you for the kind opportunity. So grateful to you. Thank you. Thank you.
Thank you so much. Thank you so much for watching, and do write to me if you are struggling, if you have any questions as a founder to another founder or investor. I would love to raise them in my next episode. Thank you so much.